that was the same case for the pandemic downturn in the New Zealand economy as well. Not very many people got irresponsibly lent money for mortgages over that period from 2009 through to 2019, 2020. Well, hello again, everybody. Come July 7, we see some changes to the CCCFA come into force. That's the Credit Contracts and Consumer Finance Act. The government a few months ago indicated they would make some changes in response to feedback from pretty much every man and his dog that the changes were too restrictive, bankers were too afraid to lend, or else they were going to get fined up to $200,000. But even after these changes, it's still going to be the case that credit availability in New Zealand is not as good as it was a year ago, and we're probably never going back to the previous environment we'd seen in place in fits and starts from the days of financial deregulation over about 1984 to 1985. Up until that time, it was relatively difficult to get a mortgage for many people in New Zealand. An old rule of thumb used to be if you want to get a mortgage, try and get a job in a bank. Well, it was never quite that bad, but one of the ways in which house prices in New Zealand were pushed up so strongly, especially from 1992, was not just interest rates trending downward, but also credit availability, the ability to get a mortgage, being relatively high. But the story of the past couple of decades has been, bit by bit, the availability of that credit getting harder. And we saw some of that tightening following the Asian financial crisis of 1997-98, the dot-com crisis of the early 2000s as well. And that meant that during the global financial crisis in New Zealand, 2008-2009, the extra downward pressure on interest rates as a result of that crisis was relatively low. Banks did not go into the GFC with anywhere near the same sort of irresponsible lending as we saw overseas. And that was the same case for the pandemic downturn in the New Zealand economy as well. Not very many people got irresponsibly lent money for mortgages over that period from 2009 through to 2019, 2020. So the period of declining prices in New Zealand was limited to those 2 months of April and May of 2020. I think the fall was about 3.5% or 4% or so. And since then, of course, prices jumped up about 44%. So far, we've seen almost 8% of those price gains given back, and probably another 8% or something like that to go, some further downside out there. But we're not going to see prices easily start rising again in the near future with the changes in the CCCFA, because it is going to still be relatively hard for banks to figure out exactly what is irresponsible lending. They're still going to be relatively cautious. But of course, for some people, the CCCFA isn't the thing that's preventing them from getting a mortgage, getting the money from a bank in order to buy, especially their first home. There's also the loan-to-value ratio rules, the LVRs, which were tightened up November of last year. And the rule change then was banks could only have a maximum of 10% of their new lending with low deposits. Previously, it was 20%. And what we've just seen recently has been one large lender in New Zealand say they're going to do no more low deposit lending for this month because they are at risk of breaching that 10% limit. And that's a way in which, because the overall housing market is coming down, there's fewer people with good deposits looking to borrow money. It actually forces the low deposit lending down as well. It acts as a bit of a cap on it. So there's sort of a bit of a reinforcing negative impact in the market there at the moment. Not that there needs to be anything extra out there with FOMO has almost completely gone. So my latest survey of real estate agents is showing only 3% of agents see fear of missing out. That was at 92% late in 2020. And FOOP, fear of overpaying, now sits at about 77% of agents say that buyers have got that worry. That was only 19% back on October. So we're still pretty much in a weak period for the housing market, with interest rates now 3 to 3.5% higher than they were about a year ago. There's still more restraint to come through, but because everything's being condensed in time, interest rates rising far more rapidly than we anticipated, house prices going down far more quickly, I think a lot of this is well over and done. This period of weakness is done and dusted by the middle of 2023, by which time I expect to see some interest rates starting to come down just a little bit. All you've got to do is get yourself through to that period. So if necessary, speak with a budgetary advisor about some of the cost savings you can make along the way until some relief eventually starts to appear with the mortgage rates going back down again. All the best.